So how many people in here have a financial model built for their company? Raise your hand. That's what I thought. For the past 7 years, I've been advising startups, and I am constantly amazed by how few entrepreneurs actually build a financial model. A few years ago, a company approached me and they said, hey, we have about $5 million in revenue, we've been bootstrapping, we're profitable, we are ready to go out there and raise capital. I thought, wonderful. I started working with this company. I was so shocked when I looked at their financials. 80% of their revenue came from one customer. And when I showed the CEO that, he said, wow, I didn't realize that. Now, how do you not realize that 80% of your revenue comes from one customer? I find that amazing. I think it's so important for entrepreneurs to understand exactly where their money is coming from. When you build out a financial model, you have your revenue, your expenses, hopefully your net income, but sometimes your net loss. But even when you have a net loss, you understand how much capital do I need in order to break even, okay? So when you build a financial model, you have a roadmap, you have a blueprint, you have a dashboard that allows you to see what is going on in your company. Now, why is that important to raising capital, and why does it have anything to do with dilution? So a lot of times I see entrepreneurs make this mistake. What they do is they just focus on venture capital. My goal is to get $5 million in venture capital. And if I do that, then I can build my company. And then perhaps I have plan B. I got no's from the venture capital world, so I'm gonna go out and talk to angel investors and I'll get a little bit of money, and then I can go out and get the VC. Oh, and then it says this afterthought, the customer's money. Revenue that comes from the customer. That's something we'll worry about later. Now, I think that is completely upside down. I think entrepreneurs need to change that. It should be the customer's money that you're intently focused on. When you think about this, you think about your target audience, who your customer is, what is the problem that you're actually solving? And you don't want to take this from a perspective of, I'm going to sell something out in the marketplace. What you are doing, you are helping. So you figure out, what is the problem I'm solving for this customer? And you go out and you solve that problem for the customer. The most important money that you can raise is the money from your customer. So you should be focused not on VC, but on getting money out of your customer's pocket. It's the most important thing you can do. Now, back to dilution and raising capital. When you're out there getting money from your customer, there's no dilution. And there's lots of ways we can do this, right? There's crowdfunding. For the year 2014, it is estimated that $5 billion will go to crowdfunding projects. Now, when you do a crowdfunding project, you're doing a lot of different things. You're getting PR, right? You're getting all this advertisement for your company for free. You're not hiring a PR agency, you're doing it yourself. You're getting capital. You're getting perhaps your seed capital that you need to seed your company. And you're getting validation. So if you decide, yeah, I do need $5 million to build this company, you have this wonderful crowdfunding project that you created, hopefully it's successful, and then you can show the world, like, hey, here's the market validation. My customers want my product. So forget about going after VC. It's the most important thing in the world. The most important thing for you building your company is to go after the customer. Maybe it's crowdfunding. Maybe you're doing a B2B, a business-to-business play. Go out and figure out, who needs the solution that you're building, and ask if they'll pay for it. And perhaps that could be your seed capital. That could be the money that you use to seed your company. And again, it's non-dilutive. So when you go out to build a company, don't just focus on venture capital, focus on getting your customers' money. And we talk a lot about financial models and how to put your company together and how to go ahead and get that capital and how to make it work for your company. And eventually down the road, you will be taking outside capital. You will be doing Series A, Series B, and Series C. Many of you may have heard the story about Angie Hicks. She's a woman from Angie's List. When her company went public, she owned 1.7% of the company. When Facebook went public, Mark Zuckerberg owned 30% of the company. So how does that happen? It's because Facebook was focused on non-dilution, right? Only building out what they need. Now, it's it's not to say that Facebook went out and raised money from their customers, because Facebook, as an ad-based model, actually had to amass users. It took Facebook 6 years to reach profitability. They had to raise over $300 million to get there. But still, Mark Zuckerberg owned 30% of the company when they went public. So if you can focus on your customers, great. If you're building a company similar to Facebook, you probably can't. You probably have to go out and raise capital. Twitter recently went public. They've raised over $1 billion before going public. So there are some models where you can't actually go out and get money from your customer, and that's okay. You can still hold on to your equity. Evan Williams owns 13% of Twitter at the point of their IPO. So I really want to stress that when you're building a company, it's so important to focus on the financial model, so you know what revenue is coming in. You know what your expenses are. You know how much money you're going to have to raise. You know how much you need for your seed. You know how much you need for your Series A, and so on and so on and so on. So you're not diluting your company. There's lots of ways to do this. You can build a cap table, which is short for capitalization table, and that will show you who's diluting, who owns what, and then it'll give you a roadmap so you can understand who owns what in my company, and hopefully it's not 1.7%. So I want to just conclude in saying when you're building a company, when you're out there raising capital, always focus on non-dilutive sources first. And if you're in a company, if your revenue model is ad-based, which requires you to go out and get lots of users before you can extract the revenue from the advertisers, always just focus on making sure that you're getting the right valuation so that you're not diluting the company. The main focus when you're raising capital is to hold on to what you know. So thank you so much for coming out today.